it has some subsidiaries. So consolidated financial statements components will be consolidated balance sheet, consolidated statement of profit and loss account, consolidated cash flow statement. Consolidated cash flow statement is required in case parent presents cash flow statement. So what is a subsidiary in parent company? We have seen subsidiary is an enterprise that is controlled by another enterprise. In this case, the another enterprise is known as the parent or holding company. How are we going to check control? Control means either more than 50% of the voting power or the power to control the composition of board of directors. That is, the holding company has powers to appoint or terminate the board of directors. Then we have seen fully owned subsidiary and partially owned subsidiary. Fully owned subsidiary means entire 100% share of the subsidiary company will be held by the holding company. There are no outside shareholders. So in these cases, 100% of the profits belong to the holding company. Entire assets and liabilities belong to the holding company. There is another type of subsidiary companies which are called partly owned subsidiary. Partly owned subsidiary means apart from the holding company, there are some other shareholders who are outside the group. So these people are called minority interest because holding company has the majority interest. The other shareholders are called minority interest. So they are also eligible for their portion of net profits. So when we are consolidating the profits of subsidiary company, if it is a partly owned subsidiary, we have to remove the minority portion. For example, 20% of the shares are held by the minority interest and the profits of subsidiary is 100 lakhs. Then 20%, that is 20 lakhs will be called minority interest. Balance 80 lakhs will be added to the holding company's profit and loss account. Similarly, assets and liabilities also, minority interest portion will be eliminated. The other portion will be taken for the computation of cost of control. A cost of control can be a goodwill or capital reserve. It depends on our share of equity, parent share of equity and cost of investment. When we compare the parent share of equity and cost of investment, we'll find out the cost of control. So whenever any company prepares a consolidated financial statement, then section 129 of the Companies Act will be applicable and accounting standard AS 21 also will become applicable. So then we have started with consolidation procedures. What a consolidation procedure? What we have to do is we have to have a separate balance sheet and profit and loss account of holding company and subsidiary company. In the consolidated financial statement, we have to simply add the items line by line. And during this process, we have to take care of few things, which is called as steps involved in consolidation process. So last class, we have started with the steps involved in consolidation process. The first step is computation of goodwill or capital reserve, which is called cost of control. And we have to eliminate the intra-group transactions. These things we discussed in last class. And adjustments in respect of unrealized profits and losses that we will discuss today. Adjustments for minority interest in the net income of consolidated subsidiaries. This also we will learn. Adjustments for minority interest in the net assets of consolidated subsidiaries also we will learn. Then results of operations of a subsidiary are included in the consolidated financial statement from the date on which parent subsidiary relationship came into existence till the date of cessation of the relationship. So this will also we will learn today. If the enterprise ceases to be a subsidiary, investment should be accounted as per AS 13. Carrying amount of the investment on the date of cessation will be the cost thereafter. So these are things we have learned and cost of control. How to compute the cost of control? The cost of control may be goodwill or capital reserve. This has to be computed as on the date of investment. We compare two things. One is cost of investment and second is parent's share of equity in the subsidiary. So we have seen that by definition, equity means net worth of the subsidiary. There are two approaches. One approach is assets minus external liabilities. The second approach is capital plus reserves and surplus. So in both ways, you can find out the equity. Then you should know the parent's shareholding percentage. If you multiply the parent's holding of shares percentage into equity, you will get parent's share of equity. So up to this we have covered. So now we will start working out the problems. Before that, we will learn more about minority interest. Let's go through the meaning of minority interest in detail. Minority interest is that part of the net results of operations and of net assets of a subsidiary. Are you able to see the Excel sheet or are you having any problems?
No, sir, clear.
Okay. I think now it will be visible to you. So minority interest is that part of the net results of operation, means their share in the net profit and their share in the net assets of a subsidiary attributable to interest which are not owned directly or indirectly through subsidiaries by the holding company. Minority interest represents the claims of the outside shareholders of a subsidiary. Minority interest in the net income of consolidated subsidiaries for the reporting period are identified and adjusted against the income of the group in order to arrive at the net income attributable to the shareholders of the holding company. As I told you, if the subsidiary's profit is 100 lakhs and minority shareholding is 20%, then 20 lakhs we should take it to minority interest. 80 lakhs we should add with the profits of the holding company. Minority interest should be presented in the consolidated balance sheet separately from liabilities and the equity of the parent shareholders. Minority interest in the income of the group should be separately presented. So whenever you are preparing a consolidated financial statement, after the capital and resource and surplus, you should have a separate item called minority interest. You should have a separate schedule for that. The losses applicable to the minority in a consolidated subsidiary may exceed the minority interest in the equity of the subsidiary. The excess and any further losses applicable to the minority are adjusted against the majority, except to the extent that the minority has a binding obligation and is able to make good the losses. If the subsidiary subsequently reports profits, all such profits are allocated to the majority interest until the minority share of losses previously absorbed by the majority has been recovered. This is a very important paragraph. We have questions based on this. So what are they trying to say? If there is a profit, the minority gets the profit. If there is a loss, the minority gets the losses. But what happens is the minority has a share in the net assets of the company. Suppose if the losses are more than the net assets, then what happens? We cannot force the shareholders to bring more money to make good the losses because companies have a limited liability. So we cannot force the minority to bring in more money to bear the losses. So what happens? Sometimes the minority interest becomes negative. We should not allow any negative in the minority interest. At the maximum, it can be a zero. It cannot be a negative figure because of the limited liability clause in companies. So in such cases, what we should do? Minorities share of loss also the holding company should take care. In future years, when profits are there, at that time, the amount of minorities losses which the holding company has taken, first they should recover that. Then only they have to give the profits to the minority interest. So we have a practical question. At the time of doing that question, you will understand this concept better. Then how to deal with the profit or loss of subsidiary company. For the purpose of consolidated balance sheet preparation, all reserves and profits or losses of subsidiary company should be classified into pre-acquisition and post-acquisition reserves and profits. What is pre or post-acquisition? We have to take the date of acquisition of shares by the holding company. When the holding company buys the shares in subsidiary and it becomes a holding company, we have to take that date as a cutoff. Any reserves or profits before that particular date are called pre-acquisition profits or reserves. Any profit or reserves created after the date of acquisition, they will be called as post-acquisition reserves and profits. Profits or losses earned by subsidiary company up to the date of acquisition of shares by the holding company are pre-acquisition or capital profits. Similarly, all reserves of subsidiary company up to the date of acquisition are capital reserves from the point of view of holding company. If the holding company interest in subsidiary is acquired during the middle or some other period of the current year, pre-acquisition profit should be calculated accordingly. So, the subsidiary company prepares its financial statements every year. So, if the holding company purchases the shares exactly on the date of the balance sheet or financial statements, our job will be much easier. We can easily find out how much is pre-acquisition and post-acquisition reserves or profit. But if the balance sheet is as on 31st March, but the holding company acquires the shares in the month of say June, July, August, that is in the middle of the year, then what we need to do? Then we have to find out the profit or loss and reserves and surplus exactly on the date of acquisition. Sometimes it is possible to prepare a financial statement as on the date of acquisition. Sometimes it is not possible. Then what we have to do? We have to do it in a reasonable manner. For example, the profit for the financial year is from April to March 120 lakhs. But the subsidiary was acquired in the month of, let's say, July 1st. Then how many months are pre-acquisition period? 3 months in the current financial year, April, May and June. So what we need to do is, based on time basis, we have to divide the profits. So for 12 months, we have got 120. So per month, 10. So in this total 120 profit, pre-acquisition will be 30, post-acquisition will be 90 because the date of acquisition is 1st July. So 3 months before acquisition, 9 months after acquisition. That's how we split the current year profits into pre and post acquisition profits. Then the minority interest in the reserves and profits of subsidiary company should be transferred to minority interest account, which will also include share capital of subsidiary company held by outsiders and minority shareholders. So I have told you, when we are preparing the consolidated balance sheet, we have a separate item. After capital and reserves and surplus, we have an item called minority interest, which should be on the liability side of the balance sheet. How to calculate this number? Minority interest is a formula where we add share capital of the subsidiary belonging to outsiders plus minority interest in the reserves and profits of subsidiary company. So this is the formula to calculate the minority interest. The holding company's interest in the pre-acquisition reserves and profits or losses should be adjusted against cost of control to find out goodwill or capital reserve on consolidation. So, we have to calculate the cost of control, which may be a goodwill or capital reserve. For calculating this, we have to consider the pre-acquisition reserves and profits. The reserves and profits of the subsidiary company representing holding company's interest in post-acquisition or revenue reserves and profits should be added to the reserves and profits of holding company. So this pre-acquisition, post-acquisition, this confusion is only for the holding company's interest, not for the minority interest. So if it is pre-acquisition, we have to consider that in calculating the cost of control. If it is post-acquisition, we have to simply add it to the respective profits and losses and reserves and surplus of the holding company. We have to read about a few more concepts, then we will start with the practical problems. Then there is one more concept called revaluation of assets of subsidiary company. So how to deal with this? Profit or loss on revaluation of fixed assets of subsidiary should also be treated as capital profit or loss. But if the fall in the value of the asset occurs after the date of acquisition, the loss should be treated as revenue loss. Adjustment for depreciation would be made in the profit and loss account of the subsidiary. Depreciation on changed value of assets shall be given effect to. Depreciation on revalued assets will be taken as capital or revenue depending on the period for which the depreciation belongs to. And we have to study about dividends received from subsidiary company, how to deal with the dividends. So as per accounting standard 13, accounting for investments, interest, dividend and rentals receivable in connection with an investment are generally regarded as income, paying the return on the investment. However, in some circumstances, such inflows represent a recovery of cost and do not form part of income. For example, when unpaid interest has accrued before the acquisition of an interest-bearing investment and is therefore included in the price paid for the investment, the subsequent receipt of interest is allocated between pre-acquisition and post-acquisition periods. The pre-acquisition portion is deducted from cost. Similarly, when dividends on equity are declared from the pre-acquisition profits, a similar treatment may apply. If it is difficult to make such an allocation, except on an arbitrary basis, the cost of investment is normally reduced by dividends receivable only if they clearly represent a recovery of a part of the cost. So, when holding company receives dividend from a subsidiary company, it must distinguish between the part received out of capital profits, that is pre-acquisition profits, and revenue profits, that is post-acquisition profits. Capital profits are credited to investment account and revenue profits are credited to the profit and loss account. If the controlling interest was acquired during the course of a year, profit for that year must be apportioned into pre-acquisition, post-acquisition portions on the basis of time in the absence of information on the point. And it should be understood that the term capital profit in this context, apart from the generic meaning, connotes profit earned by the subsidiary company till the date of acquisition. As a result, profits which may be of revenue nature for the subsidiary company may be capital profits so far as the holding company is concerned. So, how to treat the post-acquisition dividend? If it is accounted by the subsidiary, no further adjustment is required. If it is not accounted by the subsidiary, it should be adjusted at the time of consolidation. In the books of holding company, it should be accounted by crediting the profit and loss account of the holding company. In case the dividends are from the pre-acquisition profits, what should do? In the case of holding company, if currently accounted as reduction in the cost of investment, no further adjustment required. If wrongly accounted by crediting profit and loss account, we should reverse the entry that has been passed. Not accounted by holding company, then adjust the same at the time of consolidation. We have to account it as a reduction to cost of investment. Not accounted by subsidiary company. In this case, adjust the same at the time of consolidation. Reduce the pre-acquisition profit of subsidiary and then distribute it to the holding and minority interest. Also reduce the cost of investment. So these are the adjustments we need to do in respect of dividends. I'll explain this concept with some numerical example. Let's say there are two companies. One is called a holding company H, another is a subsidiary S, and the holding company purchases the shares. Date of acquisition. Let's assume the date of acquisition is 1/1/2021. After this particular date, S pays dividend for the year 2020 on 2nd January 21. 20%. So subsidiary company is paying a dividend on 2nd January itself. The holding company purchased the shares on 1st January, but 2nd January itself we get a dividend of 20%. Then how we should account? H has purchased, let's say, 6,000 shares. 6,000 shares of 100 each. And total share capital is 10,000 shares of 100 each. Somebody has joined. Okay, we'll come back to the problem. So H Limited purchases 6,000 shares of 100 each in S Limited on 1/1/2021 and S pays a dividend for the year 2020 at 20%. So per share, how much we will get? Per share, we will get rupees 20. So how much total dividend H Limited will get? The total dividend received by H will be, we have to multiply 6,000 shares into rupees 20 each. So how much amount? 1,20,000. If we know that cost of investment is, let's say, 5 lakh. So cost of investment is 5 lakh. We have invested on 1/1/2021. But immediately next day we get a dividend. We have to see what is the source of dividend. Source of dividend is the question. From which money subsidiary is able to pay this dividend? We have to see whether it is pre-acquisition or post-acquisition. In this case, how they would have got the money? They cannot make so much of amount only on 1/1/2021. And they say that this is for the year 2020. So it is the pre-acquisition profits is the source. The source is pre-acquisition profits. So this has to be adjusted in value of investment. So how we adjust? Adjustment in value of investment means we have to credit the value of investment. Credit the amount of dividend received out of pre-acquisition profit. So what we do is investment balance is 5 lakhs. It will be a debit balance. If we credit 1,20,000, what will be the answer? This will be the adjusted value of investment. So this is how we answer the question. If the facts are slightly different, then what happens? We'll see. Cost of investment. You can say it is 5 lakhs. Date of acquisition, I am keeping it same as 1/1. Let me change it slightly. 1/7/2021. And yes, pays dividend for the year 2021 on 2/1/22. Not in 21, it is in 22. And let's say per share, same 20% dividend is paid. So H acquires 6,000 shares in S Limited for an amount of 5 lakhs. The date of acquisition is 1st July 2021 and subsidiary pays dividend for the year 2021 on 2/1 for the calendar year. To make it more clear, I am just writing it is calendar year 2021 on 2/1/22. So per share dividend is 20. So what we have to do? We have to find out the total dividend 1,20,000. Now we have to decide what is the source of dividend, whether it is pre-acquisition or post-acquisition. So the period is for January 1, 2021 to 31st December 2021. But we have acquired the shares in the middle of the year, exactly after 6 months. So how we can know whether this 1,20,000 dividend is from the pre-acquisition profit or post-acquisition profit? Since no additional information is available, we have to split it based on time. So pre-acquisition period 6 months, post-acquisition period 6 months. So both are there. So the source is pre-acquisition is also there, post-acquisition also there. So pre-acquisition adjusted in the value of investment. How much? 50%. How 50%? Because pre-acquisition period January to June. January to June, we have the pre-acquisition period. Exactly 6 months. 6 by 12, it will be 50%. This should be added to the profit and loss account. Taken to profit and loss account as income. How much? 50%. How? July to December. This is a 50%. So in this case, what we need to adjust the value of investment. Credit the amount of dividend received out of pre-acquisition profit. How much is pre-acquisition profit? 1,20,000 into 50%. So 60,000 dividend should be adjusted. So what we have to do? We have to do 5 lakhs, which is the value of investment minus dividend from pre-acquisition profits. So our value of investment will become only 4,40,000. The balance 60,000 dividend will be taken to the profit and loss account as income. So this is how we have to take care of the dividends from subsidiary. Revaluation of assets of subsidiary company. So now we'll move on to the example number 3. If shares in X Limited are purchased in January 2012 and in April 2012, X Limited declares a dividend in respect of 2011. The dividend received by the holder of the shares correctly should not be treated as income but as capital receipt and credited to investment account. In case of issue of bonus shares by the subsidiary company, the holding company, like other holders, record no entry, only the number of shares held is increased. So then we'll move on to the illustration number 1. From the following data, determine in each case minority interest at the date of acquisition and at the date of consolidation. And number 2, goodwill or capital reserve. Number 3, amount of holding company's profit in the consolidated balance sheet, assuming holding company's own profit and loss account to be 2 lakhs in each case. So now we will start resolving this problem. So they have given a table where there are 4 cases and subsidiary companies given as ABCD. Percentage shares owned by the holding company is 90, 85, 80 and 100%. And cost of investment is 1,40,000, 1,04,000, 56,000 and 1 lakh. and date of acquisition is 1/1/2011, and that particular date the share capital balances were 1 lakh, 1 lakh, 50,000 and 50,000, and profit and loss account balances were 50,000, 30,000, 20,000 and 40,000. Consolidation date is 31/12/2011, exactly after 1 year. Again they give the share capital details, they haven't changed, and profit and loss account there is a change. They have become 70, 20, 20 and 55. So for this particular table, we have to find out what? The first thing is minority interest. So minority interest, we have to prepare for two different times. One is at the time of acquisition and second is at the time of consolidation. And the second item to be worked out is goodwill or capital reserve. When we will calculate the goodwill or capital reserve? Only at the time of acquisition, not at the time of consolidation. And again, amount of holding company's profit in the consolidated balance sheet, assuming holding company's own profit and loss account to be 2 lakh in each case. So now we will work out the problem. So we have to take this table, we have to prepare a table like so. This is the illustration number 1. So we have to first find out the cost of control, because cost of control we are checking only for the date of acquisition. So there are 4 cases, 1, 2, 3, 4. Then we should take the percentage of shareholding. How we find out the cost of control? We compare the parent's share of equity and the cost of investment. Then we will get the result, which is cost of control. So first thing what we want is percentage of shareholding. Second, equity on the date of acquisition. And third, parent's share of equity. So this parent share of equity will compare with the cost of investment and we will find out the cost of control. Either it can be a goodwill or capital reserve. That also we need to find out. So what is the shareholding? The shareholding is 90, 85, 80 and 100. So I will write the shareholding percentage. Case 1 90, case 2 85, case 3 80 and 100%. Now the second point what I want is equity on the date of acquisition. So how to find out the equity? There are two approaches. One is adding the capital and reserves and surplus. Another thing is take the assets and reduce the external liabilities. In the present question, they have not given any information about the assets or external liabilities. They have given the capital and profit and loss account, which is the reserves, which will be part of the reserves and surplus. So the equity of the subsidiary is the sum total of share capital and profit and loss account. So in the case of case A, it will be case 1, it will be 1,50,000. Case 2, it will be 1,30,000. Case 3, it will be 70,000. And case 4, it will be 90,000. So that will be the total equity. 1.5, 1.3, 0.7 and 0.9. So equity on the date of acquisition, I'll write 1,50,000. And in the second case, it will be 1,30,000. The third case, it will be 70,000. Fourth case, it will be 90,000. Now I have to compute the parent's share of equity. How I do it? I multiply the total equity into shareholding percentage of the parent. So the total is 1,50,000, but parent holds only 90%. Similarly, if we copy this formula, 1,30,000 into 85%, 1,10,500. Then 70,000 into 80%, 56,000. 90,000 into 100%, 90,000. So this is the parent's share of equity. Now we have to compare it with the cost of investment. So what is the cost of investment? It's also given in the table. 1,40,000, 1,04,000, 56,000 and 1 lakh. So you have to take those 1,40,000, 1,04,000, 56,000 and 1 lakh. So now we will find the cost of control. So in this particular case, parent share of equity minus cost of investment minus 5,000 we have got. So if you look at the formula for the cost of control, it can be either cost of control may be the cost of investment may be more, or parent's share of equity may be more. Based on that, we will designate that as a goodwill or capital reserve. So in this case, which is more? The cost of investment is more. Since the cost of investment is more, it will be called as a goodwill. Here in the second case, we are comparing the cost of investment. We have paid 1,04,000. But how much assets we have got? We have got assets of 1,10,500. So this will be called a capital reserve. The third case, there is no goodwill or capital reserve. In the fourth case, we paid 1 lakh but got assets worth 90,000. It means we paid 10,000 for the purpose of goodwill. So again, this will be a goodwill. Wherever our cost of investment is more, it will be called as goodwill. Wherever our share of equity is more, then we call it as a capital reserve. So that is the logic. Any questions or doubts? So this is very critical. It's a very critical computation. So this is the way we do it. Take the equity of the subsidiary on the date of acquisition, take the shareholding, multiply the total equity into shareholding percentage, we get parent share of equity. Then compare it with the cost of investment. If cost of investment is more, it is called goodwill. If the parent share of equity is more, it is called capital reserve. Then we'll move on to the next portion, which is calculating the minority interest. And minority interest, we have to do it at the time of acquisition and each time when there is a consolidation. So both the times we have to compute. Here there are 2 dates given. So we have to calculate the minority interest as on 1/1/2011 as well as on 31/12/2011. How the minority interest is computed? Minority interest is simply the sum total of minority's share in capital plus reserves and surplus plus profit and loss. So here we have two numbers only, share capital and profit and loss. So we have to see this total and multiply with the minority holding percentage. How to find out the minority interest percentage? The total will be always 100%. Out of that, holding company has some portion, parent's share of equity. Then the rest portion will be called minority interest. So we have to prepare a table like this for calculation of minority interest. We have to calculate it for 4 different cases and for 2 different dates. One, equity on the date of acquisition and equity on the date of consolidation. So for both the dates, we have to compute the minority interest. So first, what I will do, I will calculate the minority shareholding. Case 1, how much it will be? The total is 100. From that 100, I have to deduct the parent's shareholding, 90%. So minority shareholding will be just 10%. Similarly, for case 2, 3 and 4, I have to do. So second case, 100 minus 85, it will become 15. 100 minus 80, it is 20. 100 minus 0, 100 minus 100, it becomes 0. So this is the case of a fully owned subsidiary. So there will not be any minority interest. So there is no need of calculating the minority interest. The fourth case. So it will be a 0 everywhere. So in only 3 cases we will have a minority interest. So we have to find out the equity on the date of acquisition. Equity and the date of acquisition already we calculated for the purpose of calculating cost of control. So we can use it as it is. And how much is minority interest? 10% into 1,50,000, 15,000. So in the other cases it will be 19,500 and 14,000. You can quickly check this. So in the case of case 1, what is the total amount of equity? 1,50,000. It is split by between holding company 1,35,000 and subsidy the minority interest 15,000. The total is 1,50,000. So in all the cases, this will match. Here the total of 1,30,000. Here it is 70,000. Like that we can check. This cost of control, we will do it only at the time of acquisition. Only at the time of acquisition. But minority interest, we will compute at the time of consolidation. So every year we will do the consolidated balance sheet. So we have to compute minority interest every year. Now we have to find out the equity on the date of consolidation. When the consolidation will happen? The consolidation will happen on 31/12/2011. So what we should know? We have to find out the equity of the subsidiary. So here how much it will be? 1 lakh plus 70,000. It will be 1,70,000. So it is 1 lakh plus 70,000. The second case, 1 lakh plus 20,000. 1 lakh plus 20,000. Somebody has joined. So case 2 it will be 1 lakh plus 20,000. case 3 it will be 50,000 plus 20,000. The fourth case we need not worry because there is no minority interest at all. So what we need to do is we have to multiply the equity on the date of consolidation into minority shareholding, which is 10% here. So 17,000 and 15% of 1,20,000, that will be 18,000. 20% of 70,000, 14,000. So these will be the minority interest. 17,000, 18,000 and 14,000. Then what else is required? So we have to find out the minority interest both at the date of acquisition and at the date of consolidation. This is done. To find out the goodwill or capital reserve, that is also done. Now what we have to find out, amount of holding company's profit in the consolidated balance sheet. So when it will be consolidated, it will be consolidated as on 31/12/2011. If we consolidated on 1/1/2011, all these profits are pre-acquisition profits. So already taken care of while preparing the goodwill or capital reserve. So after this, whatever profit is earned, it will be called post-acquisition profits. That will be added in the consolidated profit and loss account. So holding company has a profit, standalone profit of 2 lakhs. Now we have to add share of profits in subsidiary also as on 31/12/2011. That will be added to this 2 lakhs. Then we'll have the consolidated profit and loss. So let us work out the consolidated profits. First we will take the 4 different cases and we'll find out the shareholding percentage of the holding company. It is 80, 85, 80 and 100. So we'll take that. Then profit on the date of consolidation. How much is the profit on the date of consolidation? Here they have not given the standalone profit for the period 1st January to 31st December. They have only given the profit and loss account balance. So we have to compare these two and find out the profit for the year. So this is the opening balance. This is the closing balance. When you compare the opening balance and closing balance, we will know what kind of changes happened during the year. So in the first case, it is on the date of consolidation 70,000, date of acquisition 50,000, means in this 1 year 20,000 additional profits have come. So we'll take the profit on the date of consolidation. 70, 20, 20, 55. 70, 20, 20 and 55,000. So then profit on the date of acquisition. What were the balances? You need to find. The balances were 50, 30, 20, 40. 50, 30, 20, 30, 20 and 40. So we have to find out the profit for the year. Closing balance minus opening balance will be the profit for the year. So in case 1, 20,000. In other cases it is minus 10,000. It means a loss. Then no profit, no loss. Then 15,000 profit. So how much profit belongs to the holding company? This 20% and 20,000 into 90%. 18,000 belongs to the holding company. In other cases, 8,500 loss belongs to the holding company. there is no profit loss. The fourth case, there is a 15,000 profit of subsidiary. Entire thing belongs to the holding company because shareholding is 100%. And now we have to see what is the holding company's profits. The holding company's profits are 2 lakh. In each case, it is 2 lakh. That's given in the question. Then how much is the consolidated profits? Consolidated profits is holding company's profits plus holding company's share of profits in subsidiary. So in this case, consolidated profits will be 2,18,000. We do the similar formula. Here it will be 191,500. Here it will be 2 lakh. Here it will be 2,15,000. Then how much is the minorities profit for the year? Minorities profit for the year will be 20,000 minus 18,000. 2,000 will be the share of profits for minorities. In the second case, there is a loss of 1,500 for the minorities. The third case, there is no profit at all. Fourth case, there is no minority at all. So, minorities share of profit will be 0. So, this is how we calculate the cost of control, minority interest, as well as how we consolidate the profit. I think these concepts would have been much clearer now. As we proceed with more problems, it will become better and better. So now what I would suggest is let us go for 10 minutes break. Then we will continue the session after the break. If there are any questions, we can take up after the break. Okay, we'll resume exactly after 10 minutes. Thank you.
Okay.
So welcome back. We'll start with the class. So we have completed this particular illustration number 1. We have seen how to compute the goodwill or capital reserve or minority interest and how to consolidate the profit and loss. So these are some basic concepts which we have to learn. Then only we can complete the comprehensive problems. So let's move on to illustration number 2. In this case, XYZ Limited purchased 80% of shares of ABC Limited on 1st January 2011 for an amount of 1,40,000. The issued capital of ABC Limited on 1st January 2011 was 1 lakh and the balance in the profit and loss was 60,000. During the year ended 31st December 2011, ABC Limited earned a profit of 20,000 and at year end declared and paid a dividend of 15,000. Show by an entry how the dividend should be recorded in the books of XYZ Limited. What is the amount of minority interest as on 1st January 2011 and 31st December 2011? Also, please check whether there should be any goodwill or capital reserve at the date of acquisition. So again, in this question, they have given some information. They are asking us to first calculate how to deal with the dividend from subsidiary. How we will do that? The concept is that we have to see what is the source of dividend. If the source of dividend is pre-acquisition profit, then we have to credit the investment account. If it is from the post-acquisition profit, then we can take it as a income to profit and loss account. So that's the first thing. And second thing is calculation of minority interest. Minority interest is their share in the capital, reserves and profits. So that we need to prepare at the time of acquisition as well as at the time of consolidation. And then we have to find out cost of control, which may be a goodwill or capital reserve, depends on the situation. That has to be computed as on the date of acquisition. So 3 aspects are involved. So we'll start one by one. First, we will analyze the dividend. So when they paid the dividend for the year ended 31st December 2011. So during the year, they earned a profit of 20,000 and declared and paid a dividend of 15,000 for the entire share capital. How much was their entire share capital? It was 1 lakh. For 1 lakh, they have paid a dividend of 15,000. Means 15% dividend they have paid. So now we have to see what is the source. It is for the year ended 31st December. We have to check the date of acquisition. What is the date of acquisition? It is 1st January 2011. So the entire amount of dividend is from the current year profits. So it will be a post-acquisition profit. What we have to do? We have to take the entire amount of dividends received from the subsidiary to the profit and loss account as a dividend received. So let's move on to the solution for dividend part. So illustration number 2, you have to pass a journal entry as on 31st December 2011. The journal entry will be for receipt of dividend. How much amount we will receive? The total capital of the subsidiary is 1 lakh. Of this 1 lakh, the holding company is having only 80%. So 1 lakh into 80%. into how much is the total dividend. The total dividend is 15,000. The total capital is, or we can write 80% is our dividend. So total dividend is 15,000 and 80% belongs to the holding company. Our dividend portion is 12,000. We received it. So bank account should be debited and profit and loss account should be credited. What will be the narration? It is being dividend received from subsidiary company out of post acquisition profit. So taken to the profit and loss account. Next, minority interest. How to calculate the minority interest and cost of control. So let's move on to the minority interest. Minority interest we have to calculate for two different dates. Date of acquisition, which is 1/1/2011, and date of consolidation, which is 31/12/2011. So we have to see how much is the share capital and reserves and surplus. So on 1/1/2011, the capital was 1 lakh, and there are no additional information about what happened during 31st December 2011 year ended. So that we'll assume the same thing continues. But as far as profit and loss account concerned, opening balance was 60,000. During the year, 20,000 earned and 15,000 paid as dividend. Remain the same as on date of acquisition as well as year end. Because there is no information, we cannot assume things. So we'll write 1 lakh as it is. Then reserves and surplus. The opening balance was 60,000. The closing balance, opening balance 60,000. Then we have to add the current year profits and we have to deduct the current year dividends. So it will become 65,000. And what is the equity? The total equity is given by capital plus reserves and surplus. On the date of acquisition, it was 1,60,000. On the date of consolidation, it was 1,65,000. How much is minority shareholding? Minority shareholding is 20%. So what is the minority interest? We have to multiply the value of equity with minority shareholding 20%, then we'll get the minority interest, which is 32,000. So minority shareholding doesn't changes as on the year end. So it will remain as a 20%. So the minority interest as on 31/12/2011 will be 1,65,000 into 20%. It is 33,000. So minority interest also we have calculated. Then what we have to calculate? We have to calculate the cost of control. So cost of control. When we have to calculate, we have to calculate at the time of acquisition. So we have to see what is our cost of investment. We have to compare it with the parent's share of equity. So what is our cost of investment? Our cost of investment as given in the question is 1,40,000. So cost of investment is 1,40,000. Now what we have to calculate? We have to calculate the parent's share of equity. For that we have to find out the equity first. What is the equity? Amount of equity is 1 lakh share capital plus 60,000 profit and loss account. 1,60,000 is the equity. Then we have to see what is the parent's shareholding percentage. It is 80%. 80%. Now what is parent's share of equity? Total equity is 1,60,000. And of that 80% belongs to the parent. So parent share of equity is 1,28,000. So then how much is the cost of control? The cost of control is given by cost of investment 1,40,000 minus parent share of equity 1,28,000. So the cost of control is 12,000. What it will be called? It will be called a goodwill. Why? Because our cost of investment is more and share of equity is less. It means we have paid 12,000 extra. That extra is for goodwill. So now we have completed everything. So dividend, we found out that it's from post acquisition profit. So we are taking to the profit and loss account. And cost of control, we compare the parent share of equity and the cost of investment. We found that we paid 12,000 extra. We'll call this cost of control as goodwill. Then we have calculated the minority interest as on date of acquisition as well as date of consolidation. So any questions or doubts? It is simple and straightforward by now. So I think we can proceed to the next problem. Let's move on to the illustration number 3. X Limited acquires 70% of equity shares of Z Limited as on 31st March 2011 at a cost of 70 lakhs. The following information is available from the balance sheet of Z Limited as on 31st March 2011. Property, plant and equipment 120 lakhs. Investments 55 lakhs. Current assets 70 lakhs. Loans and advances 15 lakhs. 15% debentures 90 lakhs. Current liabilities 50 lakhs. The following revaluations have been agreed upon but not included in the above figures. Property, plant and equipment up by 20%. Investments down by 10%. Z Limited declared and paid dividend at 20% on its equity share as on 31st March 2011. Face value per share is rupees 10. X Limited purchased the shares of Z Limited at 20 per share. Calculate the amount of goodwill or capital reserve on acquisition of shares of Z Limited. So here there is a concept of revaluation. So when they have acquired the shares, they have acquired the shares as on 31st March 2011. How many shares they have acquired? They have acquired 70% of the equity shares at a cost of 70 lakhs. So we have to find out the number of shares acquired. And then we have to find out the cost of control. So there is a revaluation also involved. How to take care of the revaluation, we will learn in this problem. So let's proceed with the problem. So one more thing is Z Limited declared and paid dividend at 20% on its equity shares as on 31st March 2011. Face value is 10 per share. X Limited purchased the shares of Z Limited at 20 per share. So when we purchased on the same date, dividend is declared. It means it is out of the pre-acquisition profits. So on the face value, 20% dividend is paid. So what we should remember, we have to reduce the cost of investment by this particular amount of dividend. Then only we can find out the correct cost of control. So now we will proceed with the answer. We'll find out how much is the goodwill or capital reserve. So first we have to find out the equity of the subsidiary. So for the equity, what are the two different approaches possible? One is capital plus reserves and surplus. Is there any amount of capital given? No. Any details about reserves and surplus given? No. So what we have to do? We have to go by the alternative method. The alternative method is add all the assets and deduct the external liabilities. Then we will get the net worth or equity. So here the assets are given. So we have to take the value of assets and we have to deduct the liabilities. So we'll do that by this approach. So first we will see what is the cost of investment. The cost of investment is 70 lakhs. So we'll take it. Cost of investment is 70 lakh. And we'll move to the dividend from pre-acquisition profit. We have to deduct. Then only we'll get the net cost of investment. So for that we have to find out what is the number of shares acquired and what is the value per share and what is the total value paid. So the total value paid is 70 lakh. So what is the share price? The share price is that they paid at rupees 20 per share. So how many shares they would have acquired? 70 lakhs is the amount paid. For every share they paid 20 rupees. It means they have purchased shares of 3,50,000. Then what would be the face value of these shares? 3,50,000 shares into face value of 10, it will be 35 lakhs. So how much dividend we would have received? They have paid a dividend of 20% on face value. So our face value of shares is 35 lakhs and we would have got a dividend of 7 lakhs. 35,000 into 20%. So this is the amount of dividend we would have received. We have to do this since this is the dividend out of the acquisition profits. So what we have to do is we have to deduct it from the value of investment or credit this to the investment. Investment account balance will be a debit balance. So when we credit, we get a net amount of 70 lakhs minus 7 lakhs. 63 lakhs is the cost of investment. Then now we have to find out the parent's share of equity. For that, what we have to find? We have to find the equity amount. We'll use the approach assets minus external liabilities. So what are the assets? We have 4 assets. What are they? Property, plant and equipment. What is the value? 120 lakhs. But there is a appreciation of 20%. So in terms of amount, 120 lakhs. And we have to adjust for the increase. 100 plus 20, it will become 120%. So 1 crore 44 lakhs is the value of plant, property and equipment. Then second is investments. Investments, what happened? They are down by 10%. So we have to deduct 10% here. So total value of investments 55 lakhs into 90 percentage. It is 49 lakh 50,000. Then current assets 70, loans and advances 15. Current assets 70 lakh, loans and advances 15 lakh. So now what is the total assets? The total assets are after revaluation will become 2,78,000, 2 crore 78 lakh 50,000. And we have external liabilities. How much we have? Debentures 90 lakhs, current liabilities 50 lakhs. Debentures 90 lakhs and current liabilities 50 lakhs. So what is the total of liabilities? It will be 1,40,000. So now what is the net equity amount? The amount of equity is assets minus external liabilities. It is 1 crore 38 lakh 50,000. So now what is the share of the holding company? The share of the holding company is 70%. So what is the parent's share of equity? Parent's share of equity will be 70% into 1 crore 38 lakh 50,000, which is 96 lakh 95,000. So now we have to compare what? We have to compare the cost of investment with the share of equity. So we'll get an amount of cost of control, which is given by the cost of investment minus parent's share of equity, which is 96 lakh 95,000. It is 33 lakh 95,000. It means we have paid less. So this difference will be called as a capital reserve. The amount of capital reserve is 33 lakh 95,000. Is it clear now? So only thing which is different is that they invested 70 lakhs. They did not say how many shares, but we found that how many shares by saying the per share price. So total 70 lakhs, per share 20. So we have found that the total number of shares purchased is 3,50,000. And again, we have to find out how much dividend we have got. So for that purpose, we have to see the face value of shares. So face value of shares is 10 rupees. So for 3,50,000, the total face value of shares is 3,50,000 into 10, 35 lakh. Dividend declared is on face value, which is 20%. So the face value of shares into 20%, we get an amount of 7 lakh. This is the amount of dividend received. As the dividend is paid on the date of acquisition itself, obviously the source of dividend will be pre-acquisition profit. In that case, what we have to do, we have to credit the amount received to the investment account. The cost of investment is 70 lakhs. When we adjust the dividend received out of pre-acquisition profit 7 lakhs, it becomes 63 lakhs. Usually in other problems, we have seen that we compute the equity or net worth by adding the capital and reserves and surplus. But in this case, we'll use the other formula, which is assets minus external liabilities. As well as there was revaluation. So we adjust the value of assets for revaluations. So we do the sum total of assets and sum total of external liabilities. The difference is the equity. Then we take the parents shareholding percentage, which is 70%. We find out the parents share of equity. When we compare the cost of investment and the parent share of equity, we find that there is a difference of 33,95,000, which is the cost of control. Now we have to decide whether this cost of control is a goodwill or capital reserve. If we pay more and get less of assets, it's called goodwill. We pay less and get more assets, it's called capital reserve. So in this case, what we have done, we paid less than the assets we have got. So it's a case of capital reserve. So this 33,95,000 will be called as a capital reserve. Hope there are no doubts. Then we can proceed with the next problem. Just give me a couple of minutes before that. I will start with the next problem. Okay, shall we start with the next illustration? Before going through that illustration, I would like to remind you regarding the profit and loss, how to deal with the profit and loss of subsidiary in the consolidated financial statements. Where it is? Yes, here. When we talk about minority interest, there's a last paragraph. I told you we'll take up a practical question on this concept. So this is the very important concept. The losses applicable to the minority in a consolidated subsidiary may exceed the minority interest in the equity of the subsidiary. The excess and any further losses applicable to the minority are adjusted against the majority. Except and all, we can leave it as it is because generally this kind of situations does not arise because company's liability is limited. We cannot ask the minority people to bring more money to make good the losses. So if the subsidiary subsequently reports profit, all such profits are allocated to the majority interest until the minority share of losses previously absorbed by the majority has been recovered. So this we will work out in a numerical example and understand the concept. So let's move on to the question now. So illustration number 4. A Limited acquired 70% of equity shares of B Limited on 1/4/2011. The cost is 10 lakhs. At this point in time, B Limited had an equity share capital of 10 lakhs and reserves and surplus of 80,000. In the 4 consecutive years, B Limited fared badly and suffered losses of 2,50,000, 4 lakhs, 5 lakhs, and 1,20,000 respectively. Thereafter, in 2015-16, B Limited experienced a turnaround and registered an annual profit of 50,000. In the next 2 years, that is 2016-17 and 17-18, B Limited recorded annual profits of 1 lakh and 1,50,000 respectively. Show the minority interest and cost of control at the end of each year for the purpose of consolidation. So there are several years. Our first year starts with 1/4/2011. So this is the date of acquisition. So on this date, we have to find out the cost of control. And after that, there are so many years, 4 years losses and 3 years in profits. So for total 7 years, we have to find out what is the minority interest. Some years there are profits, some years there are losses. So having that in mind, we have to work out the minority interest. So how to do that? We'll do it in a statement form. So let's move on with the illustration number 4. So we'll prepare a table. We'll have the year in the first column, then profit or loss in the second column, and minority interest in the third column. I can minimize a little. Profit and loss for consolidation purpose, then minority losses borne by the holding company. One is for the year and the other is a balance amount. Then we'll have the cost of control. Let me draw some lines. Outside borders. So now we will start with the cost of control. How to calculate the cost of control? This cost of control is only computed at the time of acquisition. If there are any major changes, then we change it. Otherwise, we keep it as it is. Every year, the cost of control doesn't change. So for that, we need two information. One is cost of investment. Other is the parent share of equity. First, I will take the cost of investment. Cost of investment. Cost of investment is given by, the value is 10 lakhs. 10 lakh is our cost of investment. We have to compare with what? We have to compare it with the parent share of equity. Parent share of equity. So for that, we have to find out what is the amount of equity. In this case, what is given? Capital plus reserves. Capital plus reserves. And we have to have the parents shareholding. Parents shareholding. So how much is the capital and how much is the reserves? The capital is 10 lakhs and the reserves are 80,000. That's what they say. 10 lakhs and 80,000. So the total equity is 10 lakhs plus 80,000. 10 lakh 80,000. What is the parent shareholding? They bought 70% of the equity shares. So 70% is the parent shareholding. So what is parent's share of equity? The parent share of equity is 10 lakh 80,000 into 70%, which is 7 lakh 56,000. So what is the difference between cost of investment and parent share of equity? It is 2 lakh 44,000 minus 10 lakh minus 7 lakh 56,000. 2 lakh 44,000 is the cost of control. Cost of control. How much we paid to acquire the shares? 10 lakhs. What is the amount of shares we have got? 7 lakh 56,000. So it means we have paid so much of amount in excess. So it will be called as the goodwill. So goodwill. Cost of control is goodwill and 2,44,000 we have. We don't have any transfer from post acquisition profit to revenue profits to capital profits in subsidiary. So this amount will not change year after year. It will be 2,44,000. So cost of control is 2,44,000. For the next 7 years also, it will remain the same. So let us see on 1/4/2011. What is the amount of minority interest? So what will be the minority interest? We have to take the share of capital and the share of profit and losses and reserves. So minority interest as on that day will be minority interest on this particular day will be their share of equity. Their capital and their share of resource. So what is the percentage? Share minority interest percentage is 30%. So what is the amount of share capital? 10 lakh. What is the amount of reserves? 80,000. So 10 lakhs into 30% is 3 lakh. 80,000 into 30% is 24,000. So total minority interest will be 3 lakhs plus 24,000 is 3 lakh 24,000. So on date of acquisition, we will have minority interest as 3 lakh 24,000. So now we'll move on to the first year. First year, what happened? There is a loss. How much is the loss? The loss is 2,50,000. So in the first year itself, there is a loss. The amount of loss is 2,50,000. So what we should do with the 2,50,000? It has to be apportioned between the minority interest and the majority interest. So minorities, they have a share of 30%. So this profit minus 75,000 belongs to the minority shareholder. Then what will be the minority interest for the purpose of consolidation? It will be 3,24,000, and this 75,000 loss will become 2,49,000. How much should be included in the consolidated profit and loss account? 2,50,000 into 70%. This will be the amount that should be shown in the consolidated profit and loss account. What will be the cost of control? It will not change. It will remain as the same, 2,44,000. So 1 year we have completed. Like this, we have to complete for 6 more years. So let's move on to the second year. Second year, what happens? There is again losses. How much? 4 lakhs. So losses will denote by a negative figure. 4 lakhs losses we have incurred. How much majority will take it? The majority will take it the 30% of that. 1,20,000. Then what will be the balance at the year end? Opening balance of minority interest 2,49,000 plus current year loss of 1,20,000. It will become 1,29,000. 2,80,000 loss will be consolidated with the profit of holding company. Then how much is the capital cost of control? It will not change. 2,44,000. So next we will move on to the third year. Again 5 lakhs losses. Right, minus 5 lakh. If we divide this 5 lakhs between the holding company and minority, and we get 1,50,000 and 3,50,000. Now, if you look at the balance of the minority interest, it becomes negative figure. 1,29,000 plus 1,50,000 is 21,000 net losses. So what happened? Now the minority interest has become a negative number. Minority interest should not be a negative number. Then what we will do? This share of loss which the minorities cannot take, the company should take it. So we will make the minority interest 0 and transfer this loss to the company. We will be getting minus 21,000. So what will be the balance at the end of the year? Balance at the end of the year, minority interest will be 0 because minus 1,50,000 plus 29,000 and 1,29,000. The minority interest remains as a 0. How much profit will be consolidated? 3,50,000 their own share, and this is the minority holders' shares. So 3,71,000. Now, how much is transferred here? 21,000. This is the minority losses borne by the holding company for the year and balance. This is the first time we are absorbing the loss of minorities, 21,000. So here also it will become cumulative total 21,000. And the cost of control does not change. It continues as 2,44,000. Then we'll move on to the next year. Next year, again, there is a loss of 1,20,000. Minus 1,20,000. They will have to share the ratio of 30% and 70%. So it comes to 36,000 and 84,000. Again, this will become a minus or nil. 36,000 minorities losses should be transferred to the holding company. Minus 36 plus 36, it becomes 0. Already holding company taken the loss of 84,000. Now they will take this additional 36,000 also. So for this year, for the consolidation purpose, the profit and loss will be 84 plus 36 minus 1,20,000. Now again, here we have to add 36,000, which is taken over by the absorbed by the holding company. So the accumulated total will be 21,000 plus 36,000. 21 plus 36, it will become 57,000. Cumulative losses of minority shareholders absorbed by the holding company. Cost of control, it will not change. It will continue as 2,44,000. And we'll move on to the next year. Fortunately, the loss years are over. Now we are moving to the profitable years, but very meager profit of 50,000. So in this year, what happened? There is a profit. How much is the profit? The profit is 50,000. So how it will be shared? It will be shared by the holding company and the minority. Minority will take 30%, that is 15,000. The holding company will take an amount of 35,000. Here, minority losses recorded by holding company. Since already we have absorbed some amount, we have to reverse it. How much we have absorbed? Earlier we have absorbed an amount of up to 57,000, which we need to recover. Now how much we are recovering? We are going to recover only 15,000. So 15,000 is taken off. So the cumulative total also will come down by 37 plus 15,000. It will become 42,000. This will be the minority losses recovered by the holding company. So here it will be added 15,000. So it becomes 0. Here it will become 50,000. So for the year 2015-16, the entire profits will be consolidated with the company's consolidated profit and loss account. Will not give this to the minority interest because still minority interest has to absorb 42,000 losses. Then we'll move on to the next year. So this is the last but 1 year. Annual profits of 1 lakh and 1,50,000. So we'll take the case of 1 lakh annual profits. So annual profits are 1 lakh. So what we should do? We have to do the apportionment as per the original shareholding ratio. So 30,000 profit belongs to the minority holders, 70,000 belongs to the holding company. But since we have already have a unabsorbed losses of minority 42,000, this will entirely go to the this one. Now how it will be reversed? They will be reversed by the holding company. So how much holding company is getting? Holding company is getting 30,000. So what will be the balance remaining now? The balance remaining will be 12,000 only. And now when we balance it, we know that this balance is 0 and this balance is 1 lakh. Cost of control will be 2,44,000. So ultimately we have reached the last year. Last year is 2017-18. How much is the annual profits? 1,50,000. So we'll take 1,50,000 and we distribute it to the holding company and subsidiary company. To do that, holding and subsidiary company, here it comes. Now, how much is the unabsorbed minority profit and loss? It is 12,000. So that one also now will be recovered. So if you recover this from the profit of minorities, so the balance becomes 45,000. This also recovered minus. So 33,000 will be the minority interest after 7 years. And how much profit should be transferred to the profit and loss account? The amount should be transferred is $1,17,000 to be the profit for consolidation purposes. Here, since 12,000 is recovered, for the year recovered is 12,000, and overall pending for recovery is nil. The cost of control doesn't change; it continues to be 2,44,000. So this is how we do the calculation of minority interest year after year. So whatever current year profits, we have to add or deduct from the minority interest. First 4 years we have deducted. After some point in time, minority interest has become 0. It cannot become a negative number. So from that time onwards, holding company was absorbing the losses of minority. But after that, the company has become profitable. So minority have got their own share of profits. So we will not pay that. We will adjust this with the already balance. there, the losses absorbed earlier, that will be reversed. So once all the reversal is happened, then the the minority interest, that figure will again re-emerge from zero for couple of years. Then now it re-emerges as a positive number because consistently 3 years profits are there. So all the absorbed losses are settled down. Going forward, we need not worry about the recovery of minority interest. So any questions or doubts? Okay. If we proceed with the other problems, I think time might not be sufficient today. So we'll see you in next class. Tomorrow I am not going to have a class, advanced accounts class. Next class will be on Monday. So see you on Monday. Thanks for joining. Bye guys.